you. Did we start looking at chapter 8 last class? And did I give you a quick, you're looking at credit sales, sales on account, and what to do if an account becomes uncollectible. Cash sales, you don't have to worry about cash sales. Whatever was sold, you collected cash. So there is no question of uncollectability for cash sales. But for credit sales, some of credit sales may remain uncollected. And did I do a chart for your last class? Right? The accounting for uncollectibles. Uncollectible accounts. You have two broad approaches. One is the allowance methods. The other is the direct write-off method, correct? Broad approaches under the allowance method. There are two approaches to the allowance. One is percentage of net credit sales, and the other is percentage of AR. Do you remember we doing this last class? Percentage of net credit sales and percentage of AR, both are acceptable allowance methods. Under the allowance method, the company creates a provision, a reserve for accounts that may go bad. They don't know exactly which customer will end up not paying, but based on the past history, they can determine a certain amount of credit sales that may remain uncollected. So, percentage of net credit sales, where do you see credit sales listed? On your income statement. Therefore, it's also known as the income statement approach. Percentage of AR is listed on balance sheet. It's also known as the balance sheet approach. Percentage of AR is also known as the aging method. So as you read the problem, identify which method the company is going to be using. Good? I want to show you how to do percentage of net credit sales, how to do percentage of AR. Do you have your PowerPoints with you? PowerPoints were posted last week. Did you bring a copy of the PowerPoint? How many of you did? Is the PowerPoint not available in Pt.1? Somebody vouch for it? Is it there? Anybody to vouch to say it's not there? You should bring the copy, printed copy of the PowerPoint so you can see what's being done. example in the PowerPoints that I'm gonna do in class. How will you follow that? So I'm gonna look at an example using percent net credit sales, and I'll take basically the same example and show you percentage AR, so you can see the difference between the two methods. In some ways, the two methods are pretty much identical, but the basic difference between the two methods is how the amount of allowance is created. The process used in determining the amount of allowance to create. Otherwise, both the methods are pretty similar. So I'll take the same example and I'll show you. See if I can have this. I'm going to move on with the first few slides. You can go over the PowerPoint and some of the first few slides you can read and be able to understand on your own. So I'm going to move on, okay? Basic understanding of the two methods, things of that sort. I'm not sure how much I'll go into notes receivables. If we have the time, I'll do so. But the heavy focus would be on the two allowance methods and a little bit on the direct write-off method. Yeah, so I'll let you go over these slides on your own. Here's an example. So, looking at percentage of net credit sales. Some of the transactions you will have before, you've seen that before, and you can certainly help me as we do this process. The following information for Vikings Company for 2010 and 2011. I've given you 2 years, so you can see what happens the next year. And here I'm assuming that, can you make that correction, Dave? Year 2010 is the first year of operation. I'm assuming 2010 is the first year of the company's operations. A brand new company starting in 2010. And December 31st is the year in accounting, the accounting year end. So let's look at that method and if you can help me out. What has happened in 2010? Net credit sales for the year was $200,000. So the total credit sales for the year was $200,000. Can you record that transaction for me, net credit sales? Can somebody help me do that? Hello?
The accounts receivable,
Debit accounts receivable for what?
200,000.
200,000.
And sales revenue.
And sales revenue of 200,000. You have seen this transaction before. So here's your credit sales for the year. Come December 31st, the company wants to create an allowance. The company wants to create a reserve for accounts that may go bad at the rate of 2% of net credit sales. Net credit sales is gross sales minus returns minus sales discount. Net credit sales. Gross sales, credit sales minus sales returns minus sales discount. Come December 31st, the company wants to create an allowance. They want to create a provision. They don't know exactly who will not end up not paying, but based on what other companies are doing, they believe approximately 2% of net credit sales will remain uncollected. If no information is given to you about sales, then you can assume that sales is net credit sales. 2% of net credit sales. My credit sale was what, 200,000? How much would it be? Would it be 400,000? So come year end, the company wants to create a reserve. December 31st. They don't say exactly who will not pay, but they want to create a provision. No debit, bad debt expense for $4,000. And you credit an account called allowance for doubtful accounts, $4,000. Allowance for doubtful accounts, $4,000. Where would you find bad debt expense? If it's an expense, where do you think you would see this?
Income statement.
Is it an income statement account? A nominal account? It will have a normal. The normal balance is debit. And it's an income statement account. So it will affect your net income for that year. It will be deducted like any other expense from your revenues to derive your net income. So it will affect your net income. What kind of an account is allowance for doubtful accounts?
Balance sheet.
Yes, it's a contra to accounts receivable. Contra to accounts receivable. Remember accumulated depreciation of contra asset? So is allowance for doubtful accounts contra. What's a normal balance for AR? Debit. So the contra account, contra means opposite. It'll have a normal credit balance. The normal balance is credit. On what statement do you find AR listed? Is it a balance sheet account? So the contra asset is also a balance sheet account. It's also a balance sheet account. You with me so far? Any questions up to this point? Any thoughts, any questions?
Well, what's the DA stand for?
Doubtful accounts? Any other questions? Now, I want to show you the balance sheet presentation. Come year end, the AR balance. This is provided to you, given to you. The problem gives you this information, given that the AR year-end AR balance is $80,000. The balance sheet presentation. You should know how to do this. December 31st, 2010, let's, under your assets, you have your current asset. Your AR, the year AR balance is what, $80,000? Less allowance for doubtful accounts. Is it 4,000? The net is 76,000. The balance sheet presentation. This 76,000 is net receivables. Call it net receivables or net realizable receivables. Essentially, after everything is said and done, the company expects to collect $76,000. They anticipate they'll collect $76,000 from the remaining AR. So know these entries and know the balance sheet presentation. Sometimes they may ask you in a multiple choice question, what's the net receivables? Clear? Questions up to this point?
Yes. So for number 3, that's how we would do it, is put it into the balance sheet, or you journalize that at all?
No, just the balance sheet. The journal entry has been done.
Okay.
Can I move on to the next year? 2011? Now I want to show you what happens in 2011. On Jan the 4th, Able Company, a customer of the company declared bankruptcy. So now Able is no longer in business, and United Vikings is unable to collect the $3,000. So Abel's account has to be written off. On Jan the 4th, what would you do to write off Abel's account? When an account is written off under one of the allowance methods, you debit allowance for doubtful accounts. And the amount to be written off was it $3,000? Your debit allowance, that's why you created that allowance. That when an account does go bad, it'll be used to absorb that loss. And you'll credit accounts receivables for $3,000. You're gonna write off Abel's account. So you wrote off Abel's account. Now let me ask you a question and see what you think. Let's say nothing happened between Jan the 1st and Jan the 4th. The only transaction that took place between Jan the 1st and the 4th of 2011 is this write-off. No sales, no collections, nothing else took place except this write-off. Now, because of this write-off, what do you think would happen to my net receivables? Will it go up or will it go down? Will it go down? Think so? Here it is. I'm preparing a balance sheet. Jan the 4th, 2011. With me? What's the balance in my AR after this write-off? Did I reduce my AR by 3,000? End of last year, what was my AR balance? 80,000, correct? I reduced AR by 3,000. What's the balance in my AR? My AR beginning balance was 80,000, correct? We credited AR for another 3,000. Is my balance in AR now 77,000? Clear? What about my allowance for doubtful accounts? Is that a balance sheet account?
Yep.
So therefore, is it also permanent account just like AR? Will last year's ending balance become this year's beginning balance? End of last year, did you have a balance of 4,000 in allowance? Permanent account, last year's ending balance, this year's beginning balance. Agreed? On Jan the 4th, did you debit allowance for 3,000? On Jan the 4th, was the allowance account debited by 3,000? The balance in allowance, what is it? After this write-off, is it $1,000? my net receivable after this write-off? 76,000. That's exactly why you created this allowance to begin with. So that when an account does go bad, you can let absorb that loss. Do you notice when you created the allowance, that's the time you debited the expense. That's the time it affected your net income. Are you with me? When you created the allowance, and that was the time it affected your net assets. So when you created the allowance, that's the time it affected your net income, and it affected your net assets. When the actual write-off takes place under the allowance method, it does not affect your income statement. Do you notice both are balance sheet accounts? One is contra asset, and the other is an asset account. Both are balance sheet accounts. This entry does not affect the income statement at all. It has no expense there. It doesn't affect the income statement at all when you write off this account. And it doesn't affect your net assets either. So when you really write off an account, no effect on your net income, no net effect on your net assets. It's when you create the allowance, that's the time it hits your income statement and therefore affects your net income. And it also affects your net assets. With me on this? I wrote off this account on January 4th.
I got a quick question.
Yes, what is it?
I'm just curious why you used this, after you did the 2010, and you took the less of the allowance and you got 76,000. Wouldn't that be your starting for the accounts receivable for 2011, not 80,000? I'm just wondering if I.
My gross AR is 80,000. My allowance was 4,000. I haven't reduced my AR. My gross AR hasn't been reduced.
Okay.
I don't know exactly who will not pay, but I've created a provision for accounts that may go bad. When an account does go bad, then I hit the accounts receivables. Then I want to take able out of my AR. That's the time it reduces my AR, and my allowance is affected. But when I created the allowance, all my AR is still on my books. I haven't written off anything. But I've created a reserve for something that may go bad in the future. My net receivable is 76,000, and here's a breakdown of that net receivable. Huh? How do you know? For example, on January the 4th, Abel declared he's bankrupt. I can collect on Abel. Maybe he's no longer in business. I need to write that off. Prior to that, I don't know exactly who will not pay, but I have a general idea. Some accounts will go bad. And based on that assumption, I've created a reserve for accounts that may go bad. Okay? So we wrote off Avon, 4,000. You with me on this so far? Guys? Up to that point, you're okay? Let's say Abel and Company, they're good folks. They come back to you, they say, look, we're terribly sorry, we couldn't pay 3,000. We're going through a difficult period of time. We still can't pay you the entire 3,000, but we can pay you $500 of what we owed. And we still would like to do business with you. And let's say you agree to that. Say, okay, fine. Give us your $500. They promise to pay 500, you collect 500. So you're going to reinstate Abel and Company to the extent Abel promises to pay. If Abel and Company promises to pay 500, you're going to reinstate Abel and Company only to that extent. So on Jan, I said, I'll give it a date, how about if I give it a date? How about August the 15th? You want to reinstate Able and Company, and you're gonna collect from Able and Company. If you're gonna reinstate, I'm gonna debit AR of 500. If they promise to pay 500, I'm gonna reinstate only to that extent. And you credit allowance or doubtful account. You're gonna put it back in the allowance account. And then you debit cash for 500, they pay you 500, you credit AR, Able 500. But two separate journal entries. You can shorten it and merge it into one. If you do that, there will be no audit trail of reinstating Able and then collecting from Able. The two separate journal entries. First, you're going to reinstate Able, and then collect from Able, so cash, credit, AR. With me on this? Net credit sales for 2011 was 210,000. Can you record this in your notes? I'm not gonna do it here, but can you record it in your notes? Accounts receivables, 210, and credit sales revenue, 210. You can do that. Very similar to this entry in 2011. Debit AR for 211, 210, and credit sales revenue for 210. Do that. Fine. Record the credit sales, like we've done this here. Debit AR 210, credit sales revenue 210, so that you have it in your notes. Good. I'm going to move on. Okay to move on? Okay. Let's say, and then come December 31st, the company believes that 2% of credit sales is a fairly good estimate. They want to stick with 2% of credit sales. So 2% of credit sales, 2% of what is it, 210,000?
4,200.
4,200? Will they create allowance to the extent of 4,200? So December 31st. You will debit back that expense. $4,200 and credit allowance for doubtful accounts, $4,200. You feel this? Clear? Under the allowance, under the percentage of net credit sales method, let me just give you this formula. The amount of new allowance to create. The amount of new allowance to create. All you do is take a percentage and give it to you the problem times net credit sales. That's all you do. There's nothing more to it. You take a given percentage, the assumption is made for you in the problem, times net credit sales. That gives you how much of new allowance to create. Simple as that. Have I given you the year-end balance of AR 90,000? I've given you, the problem gives you. You don't have to compute. gives you the balance in AR at the end of the year, 90,000? What's going on with the allowance for doubtful accounts? Did the year start with 4,000, last year's ending balance, this year's beginning balance, agreed on Jan 1st? Last year's ending balance, this year's beginning balance? Look at what has happened in 2011. Did you debit allowance for 3,000? Do you see it? Did you credit allowance for August of 15? Did you credit allowance for $500? I'm showing you my allowance account. I'm showing you how it falls to the allowance account. Come December 31st, 12/31, did we credit allowance for $4,200? What's the balance in my allowance account? Somebody vouch for that? Is it 5,700?
Yeah.
Balance in my allowance account. If I were to ask you to determine the balance in net receivables, December 31st, can you do that? December 31st, 2011. The accounts receivables balance as per the calendar, is it 90,000? What's the balance in my allowance for doubtful account? Is it 5,700? What's my net receivable? 84,300? Did you do this computation? Clear? Questions?